High income does not automatically mean high wealth. In fact, some of the highest earners that we speak to are actually the most under-leveraged investors in this country. They earn well, save well, but their money isn't actually working harder for them. For those who don't know, I'm AJ, director at Handle Properties, where we buy about $10 million of property every single month, and we're growing. We work with a lot of professionals earning seven-figure incomes: doctors, executives, business owners, and we help them turn their income into scalable property portfolios, not just a comfortable lifestyle. And here's the key point up front. A high income earner has a massive advantage, but if you know how to use it to actually get into property. If you don't, it can quietly become a wasted opportunity or maybe even increased lifestyle pressures. One of the biggest misconceptions that we see is, I earn a lot, so property will take care of itself. Well, guess what? It doesn't. High income gives you capacity, not strategy. Without a plan, high earners often end up with this: one or two high value properties, oversized home loans, strong capital growth, but not really much cash flow, and a borrowing power that really stalls early on in that journey. At the same time, regulators are tightening lending standards, and especially around debt to income ratios and serviceability buffers, which means if you don't structure things correctly early, your borrowing power can disappear faster than you actually expect. That's why how you leverage your income matters just as much as how much you actually earn. Wealth through property is not built just by savings. It's built by using leverage sensibly and over time. Your salary does three important things for you. Firstly, it supports higher borrowing capacity. Secondly, it observes short-term holding costs of that property. And finally, it allows you to recycle your equity much more quickly. But leverage needs to be controlled and not maximized blindly. At Handle Properties, the goal is not to stretch a client to their absolute limits. The goal is to create a repeatable borrowing power strategy. That's how portfolios actually scale over time. High income earners don't need complicated tricks. They need the right fundamentals executed perfectly. Here are the tools that we focus on the most. Firstly is interest-only lending, if used correctly. Interest-only loans are not about avoiding repaying the capital over time. They're about cash flow management, tax efficiency, and preserving your borrowing capacity to scale that portfolio. Used strategically, they can allow investors to control their servicing whilst that asset grows in value. Second up is debt recycling. This is one of the most powerful and most misunderstood strategies for high income earners. Done correctly, it can allow you to reduce your non-deductible debt to progressively be converted into deductible investment debt without increasing risk. Thirdly, we look at multiple lenders. Using one bank for everything is convenient, but it's usually a mistake. Different lenders assess income, liabilities, and risk differently. They have varying policies as well. Strategic lender sequencing can materially increase how many properties that you can buy over your investment journey. Then we look at multi-entity strategies as well. A multi-entity strategy allows investors to manage risks across assets, protect personal income and balance sheets, preserve borrowing capacity for a longer period of time, and access different lending rules across the entities that they're investing in. This isn't just about complexity for the sake of it. It's about keeping the doors open so you have more choices as you go on in your personal investment journey. Leverage only works if risk is managed properly. For high-income investors, this means keeping buffers and offset accounts to avoid risk, avoiding over-concentration into one lender, not cross-collateralizing properties so you get stuck, and stress testing your property portfolios at higher interest rate levels to make sure that repayments aren't a problem. The aim is not to avoid risk entirely, but rather it's to ensure temporary market or policy changes don't force you into bad decisions. This is especially important in an environment where lending rules can shift very quickly, as we've seen over the course of 2025. More may happen in the coming year as well. So what does this all look like together and in practice? A typical pathway could look like this: optimize loan structures on your existing assets, set up the right company and trust structures early, deploy income to support early acquisitions, and look to buy growth-focused assets first. Then, recycle equity as values rise, repeat using multiple lenders, and gradually transition into stronger cash flow properties as your portfolio matures. This is not about buying 10 properties overnight. It's about building momentum that actually compounds for you. Here's the reality. Your income is your biggest asset, but only for a limited period of time. Markets change, policies change, and your careers might actually change as well. The investors who win are the ones that convert that high income into assets early in their journey, whilst their serviceability is still strong. If you're a high income earning professional and you want to turn this advantage into a long-term property wealth play, not just a nice lifestyle, then reach out. At Handle Properties, we buy $10 million of property every single month, and we help our clients use their income strategically, not emotionally. Like, subscribe, and comment if you want a follow-up video where we walk through real client examples from high income to multi-property portfolios step by step.